4 ways to create wealth in just 12 months. If you have money sitting in your account and don't know where to invest it, in the next 10 minutes, I will tell you 4 investment options that will build your wealth just in 12 months. We'll go from the absolute lowest effort, lowest risk option, all the way to the highest investment returns. And the last option is a tax saving hack that even your CA might not tell you. But first, let's start with an investment where you are actually losing money. Savings account. In a savings account, your effort is low, the risk is low, and the returns are, well, low. A typical savings account gives you 2.5 to 3% interest. Now, while the current inflation rate in India is just 0.25%, it swings between 3 to 6%. So it means your money over the long term does not grow if you keep it in a savings account. That's why if you have a large amount in your savings account, you should prefer investing it in any one of the next 4 options that I'm about to tell you. But if you like to keep some extra amount in your savings account for your peace of mind, or if your work requires you to keep extra cash flow, then you should enable the auto sweep feature in your bank account. Basically, you can tell your bank account to set a threshold, say 50,000. If your bank balance crosses this amount, that extra amount automatically sweeps into a fixed deposit. You don't even have to do anything. So if you have 3 lakh rupees in your account, 50,000 stays in your savings account, earning a 3%, and the rest 2.5 lakh is instantly moved into an FD, earning up to 7% interest. But what if you need to pay, say, a bill for 1 lakh rupees? See, unlike a normal FD, there is no lock-in when you enable auto sweep. The bank just reverses the sweep. They pull the 50,000 from your FD and you can make the payment. Now, some banks might charge you a penalty on your interest depending on how early you break that auto sweep FD. So make sure to check the terms of your bank before you enable this feature. FD and RD. Okay, now let's move to an investment where you can actually make some decent returns. The good old Papa ka favorite, fixed deposit. This is one of the easiest, safest, and liquid options to hold your money for a short-term period. That's why FDs are considered a great option for your emergency fund. Typically, FDs can give you a 6 to 7% interest, which is a decent interest to keep up with inflation. Now, one of the biggest reasons why FDs are considered safe is that the RBI gives you an insurance of 5 lakh rupees per bank per depositor. So in case your bank shuts down, your money will remain protected. This means if you have a fund of, say, 7 lakhs, don't put it all in one bank. If the bank goes bankrupt, you're only guaranteed to get 5 lakhs back. So keep 5 lakhs in bank A and 2 lakh in bank B. Now, if you're saving money from your salary, say for an international trip, creating an FD every month might be a big hassle. In situations like these, you should start a recurring deposit or RD. It's like an SIP for FDs. You can set a date, say the 5th of every month. The bank auto debits and deposits the amount you select into your RD. You get a locked-in interest rate, and at the end of your selected tenure, you will have your money back plus interest. But remember, if you withdraw your FD or RD before the maturity date, your bank might levy a penalty on the interest you earn. Also, the interest you earn via these is taxable per your income slab. Our next investment option is where things get interesting. What if you want FD-like safety and liquidity, but with potentially better returns? This is where liquid mutual funds fit perfectly. A liquid fund's return isn't fixed. It depends heavily on the RBI's repo rate. In simple terms, the repo rate is the interest rate at which the RBI lends money to big banks. If the repo rate is high, FDs usually get better returns. But if liquid mutual funds are mutual funds, shouldn't the returns be risky? Well, no. The returns of liquid funds are quite stable and often a little better than FD because of 2 reasons. First, asset allocation. A typical liquid fund invests its funds in T-bills, certificates of deposits, and commercial papers. The chance of all of them defaulting at once is almost 0. Second, they only invest in debt that matures in less than 91 days. So there's very little risk here compared to longer loans. And like FDs, the liquidity is high too. You can redeem your money and have it in your bank account in 1 working day. But liquid funds offer one more feature over FDs. There are 2 types of liquid mutual funds, growth or IDCW, which is income distribution cum capital withdrawal. If you select the IDCW option, you can get the interest daily, weekly, or monthly depending on the fund you invest in. So if you want regular cash flow, this might be a good option for you. A growth mutual fund, on the other hand, is your typical fund where the interest gets credited the day you sell the fund. And like FDs, earning from liquid funds are taxed as per your tax slab. So if you fall under the 20% or 30% tax slab, your profits can take quite a hit. That's why our next investment option solves this problem for you. Arbitrage mutual funds. Arbitrage mutual funds are best for people who are in the 20 or 30% tax bracket. If you're in a lower tax bracket, wait for the next point because that will give you the maximum returns. So an arbitrage fund gives you the returns a little higher than a liquid fund, but it has a massive tax advantage. Let's first understand how arbitrage funds give you better returns than liquid funds. See, an arbitrage fund's job is to exploit tiny price differences in the market. Here's a simple example. Say the fund manager sees TCS stock in the cash market for 3,000 rupees. At the exact same second, he sees the TCS future contract for the next month trading at 3,025. The fund manager instantly buys the stock at 3,000 and sells the future at 3,025. And that's it. He has now locked in a risk-free profit of 25 rupees. That's why these funds do best when the market is volatile or when F&O trading activity is high, because that's when the price gap gets wider. Now, what if there's no arbitrage opportunities? In those situations, the fund manager just parks the money in liquid funds and short-term debts. And how do you save tax, you ask? Let me explain how. Arbitrage mutual funds invest at least 65% of assets in equity, so they're taxed as equity funds. So if you sell these within 1 year, you need to pay 20% STCG tax. Otherwise, you'll have to pay 12.5% LTCG tax. Simple. And this changes everything. Let's say you're in the 30% tax bracket. You invest 10 lakhs for 13 months and earn a 60,000 rupees gain. In a regular liquid fund, that 60,000 is added to your income. You pay 30% tax on it, which is 18,000 rupees. But in an arbitrage fund, because you held it for more than 12 months, this is long-term capital gain. And for profits less than 1.25 lakh, the LTCG is 0%. Hence, the tax liability will be rupees 0. So just by buying the arbitrage fund, you saved 18,000 rupees in taxes by doing nothing. Now, in case your profits are more than 1.25 lakh, the LTCG will be just 12.5% on the profits over 1.25 lakh, much lower than the 30% income tax. So there you have it. 4 ways to take your idle cash and put it to work for you. Which one of these are you going to invest in? Tell us in the comments.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.